Okay, so I want to get started by talking about the past year. It's been an interesting year for our industry.
I would say that's an understatement.
Yes, so I guess let's just start and say, if we look back a year ago, or even at the start of this year, and we look to today, what is different now than what it was a year ago? And Matt, why don't you start us off?
I mean, I think a lot of the conversations, it's really interesting to come to this event because you get a little bit more outside perspective. In the U.S., we're almost too much in the weeds to look up and actually see what's going on. But overall, I think the hype is gone in the U.S. market. It's much more difficult to raise equity capital. The bar has been, I would say, doubled in terms of being able to both have market adoption, raise money, kind of all of the metrics. If you're an entrepreneur just looking for like the quick money, you're in the insurance space right now. You're not in the lending space. And over the next couple of years, I believe that is where the real businesses will be built in this space. It's not going to be easy, but I think that the lasting, 50, 100-year businesses will now be built. That the hype is out of the market in the U.S. So definitely a different stage than last year.
So so let's just talk a bit about that. Maybe Finn, you can give us a perspective on, Matt said the bar's been raised. I presume at your company, if people are still trying to raise money, but it sounds like it's a lot harder to get people to write checks.
So, for sure, I agree with everything Matt said. We made one investment this year, and it was very specifically into a highly vertical, very niche-y lender, and no other lenders. Not only has the bar been raised, I put it even one step further, which is people have started to be they realize they can't raise the debt and equity to actually finance their own loans, so they're going towards corporates and banks and established players and more collaborative approaches, more sort of bolt-on approaches and less disruptive approaches. So even the nature of the business that they're trying to raise at have changed. Whereas 3 years ago, you would have had people say they want to disrupt banks and launch on their own and sort of do something new and different. I think you're seeing a lot less of that now. Mm-hmm. And by the way, venture funding has gone way down. It's gone down 50% globally, and in the United States, probably even more in fintech. Mm-hmm.
Mm-hmm. So Ram, what are you seeing that's different?
Sure. No, I think it's been quite a contrast last year to where we are today. So around last year at this time, the U.S. Treasury had compiled some responses, and generally they were very favorably received as regards to marketplace lending, its role in expanding credit to underserved consumers and small businesses. Since then, there had been really a cacophony of negative news, everything from deterioration in credit performance. We had seen a 30, 50 bips increase in delinquencies to news from San Bernardino, increased regulatory scrutiny. You've also had deals that went to market, primarily the Chai shelf, where you had the mezzanine bond and securitization that delivered greater return than the whole loans themselves. And of course, you had really the capitulation with the Lending Club May 9th events. And now I think what you're seeing is increased focus really on the capabilities that historically have not been top of mind for platforms, whereas historically the conversation was on origination growth. Now you're seeing more discussion on robust internal controls, the need to create transparency, the need to create standardization, and also tools to create investor fairness. So valuation becomes more important when you're offering liquidity to investors on collateral. Ensuring you have term financing both for loan purchasing, so you have the capacity to participate when spreads widen, as well as term financing on the leverage you have as well. So I think really back to the basics, focusing on the nuts and bolts to ensure that we have the appropriate risk infrastructure to help the category scale.
Mm-hmm. So Catherine, you're our one representative from a lending platform. How has this year been, and take us through the last 12 months and how it's been for you guys?
I would say we've been very fortunate to mainly remain above or below the fray, however you want to describe that. Largely just because we weren't publicly traded. We fund our loans differently. We weren't dependent on retail investors or on temporary institutional investors. So I think we probably had a lot more stability, but we spent a lot of time over the last year educating people. We're educating debt and equity investors, we're educating regulators, we're spending a lot of time helping folks understand the difference. I think the biggest difference is that now there's a little less effervescence around, really rapid growth, and people are focusing on, does it really matter if you're a marketplace lender, or you're a peer-to-peer lender specifically, or if you are a balance sheet lender? None of those things. The differences are less important now because what's important is performance, what's important is transparency and compliance. And I think any of the folks who've been focused on that for a very long time have had far less turbulence over the last 12 months.
Okay, so did the capital markets slowdown affect you at all, or have you literally had no impacts?
Well, despite the fact that we have this $1 billion facility that we use, we still have to sell into it all the time, and that's gotten harder. It takes longer. That's eased up a little bit. It was particularly hairy, I would say, December through February. But I want me to just go ahead and use that example that we talked about earlier. Okay, so we launched a year and a half ago. We launched a consumer lending product called Carrot. And we were excited about that for two reasons. One is it was the first sort of white label version of our platform that we were able to get up quickly. We launched that in 60 days. And the capital markets had an impact on that product because while we could certainly offer and sell a lot of consumer loans, it was hard for us on the capital markets side to fund them. And it wasn't hard at first, but it became harder come November, December, January. So we actually stopped originating consumer loans. We weren't out in the market actively marketing them, but we had a lot of passive consumers coming to our site, so we were offering that product to those consumers. So we were glad we launched it because it really springboarded our platform business. But by the same token, we certainly discovered that that was a hard debt situation for us.
So then, with the Lending Club situation, I mean, Ram, you started talking about it. The increased focus on compliance. I mean, what else have you noticed in the marketplace when you're talking to platforms that how has not just their focus changed, but how has sort of the mood of the companies that you're talking to, how has that changed?
Well, the mood varies from platform to platform. So what you're really seeing is differentiation in funding costs as well as loss performance across the industry. So 6 months ago or a year ago, marketplace lending really acted as a frontier asset class. Capital would come in together, it'd ebb and flow together, and now you're starting to see distinct differentiation. For example, SoFi continues to grow dramatically. They just priced a new deal this morning. Their funding costs rivals AAA rated institutions. Other platforms have scaled back the origination and they're developing securitization programs and focused on standardized repeat issuance. You've seen that now with the Lending Club Investment Trust shelf. Prosper reportedly is introducing a shelf to the market as well. So now what you're having is platforms are investing in tools to create investor confidence. That's going to take some time. So what investors need to know are, number one, do the loans exist? Number two, do I have access to the borrower documentation in a third-party vaulted format so I can perfect my interest in the loans if I own the loans or if I'm financing the loans? And number three, can I verify that the rates and stated terms on the loans correspond to the loan tape? And if you can solve those three things, then that'll really improve investor confidence and help more capital enter the category.
Right. And so Matt, you're talking with investors every day. I mean, how the Lending Club incidents, how has that affected the investor sentiment, and what are investors asking now that they weren't asking 9 months ago?
Yeah, I mean, I think Ram hit on a lot of the points there. I mean, we saw there was a massive group of institutional investors that was moving into the space, and these were less hedge funds that were setting up kind of specific marketplace lending or online lending funds, and more large $100 billion plus asset managers that were creating a new sleeve to invest in this asset class. And from a timing perspective, it was difficult because when most of them were about to go to credit committee, or many of the large early ones, was right when the Lending Club news hit. So all of those efforts just went on freeze. And so we saw basically they took the entire summer off. So they basically said, look, we're still interested, please give us updates, but there's no way we're taking this to credit committee anytime soon. And we've seen some of those investors start to come back, but it's a very slow process. I think what you realize is that investor trust is something that takes years to build and seconds to lose. And so it's one thing that you have to realize when you're building a business in this space, that you have to dot every I and cross every T and have systems in place so that you don't lose that trust.
Right. And so I noticed, I had lots of conversations yesterday. I noticed sitting here, and many of the speakers talked about one company that seems to be unaffected. And I just want to talk about SoFi just for a second. I know, Finn, they're one of your portfolio companies, and it seems in some ways they are sort of separate from the industry because they seem to be unaffected by anything that happens. And Maram, you just talked about the pricing that they have. I mean, can we just talk about them for a second? How have they been able to stay unaffected?
So raising $1 billion right before the crash helped a lot.
That helps a lot.
So SoftBank put in $1 billion at a $2.25 billion valuation, which was tremendously significant. The second thing SoFi did was they sort of, unlike the rest of the industry who didn't have that capital and didn't have the ambition maybe they had, they started trying tons of new things and really spending money to expand and grow, and while maintaining discipline in their core area. And so while everyone else has been cutting products, cutting new efforts, rationalizing their business, SoFi has been willing to launch new products. I think 2 new products this year so far, maybe 3 if you count SoFi at Work, which is just, I mean, they probably single-handedly launched more products than half the other top 10 companies. So I think that was important. Secondly, I do think it's part of a more general trend, I think, of a barbelling of the sector, which is, I think the super high-quality stuff has been okay. The defaults have been fine, sort of a little bit more resistant to the economic downturn and people's concern. And in a weird sense, like, there's a true regulatory arb there, where if you can redline without redlining and you're a non-bank, you can get away with having really good credit in a way that banks literally cannot compete with you. They don't do that, right? So if you're Citigroup or you're JP Morgan or you're like, Wells Fargo, you simply cannot cater to the top 10% of the market for lots of reasons. And then secondly, this bottom of the market's done fine too, right? So we've had like payday lenders, and maybe it's always crisis situation for most of their customers, but you haven't really seen anything horrible happen there. You've seen things go fine. You saw an IPO get pulled just recently, but beyond that, volumes and credit and profit margins are all fine. So it's really the middle of the market that's gotten hurt, and that's probably one reason why SoFi has done better. Right. Also, Nino and Mike are stunningly good operators.
Right, sure.
I think it's also a factor that they started out with a hybrid model on the capital market side and have been very open to opening up every funding channel they possibly can, right. Whether it's selling whole loans, whether it's securitizing, whether it's using their balance sheet. And they really have one of the most sophisticated cap market teams in the entire industry. And I think one of the things that I've noticed is that the teams that have really excelled at that spend a lot of time in New York. The teams that have struggled have based their cap markets teams outside of New York in the U.S. and don't spend enough time on a plane.
Spend a lot of time with Pure IQ as well.
Right, of course. So I want to switch gears a little bit and talk about regulation and the regulatory environment. We have, in the US, there's been a lot of interest from regulators. I mentioned this yesterday, unlike the UK, where there's really one regulator that you have to deal with. In the US, there's many. And I want to start with you, Catherine, just talking about, like, what you're obviously having conversations with regulators. I mean, what are you hearing from them? Are they up to speed? What are they really trying to accomplish, do you think?
I think their level of knowledge is across the board. I spend a lot of time with all of the 3 and 4 letter regulators. I'm in Washington, D.C. constantly. We spend most of our time just educating, talking about the industry itself, helping them understand that fintech isn't the same thing as marketplace lending, isn't the same thing as balance sheet lending, isn't the same thing as being a non-bank. And I think that's taking a long time for them to understand. I think, everybody's knee-jerk reaction was, oh, these guys are all out here trying to avoid regulation. And I think helping them understand that that's not really the case and that it's possible to be incredibly compliant, if not more compliant, and more transparent and more fair with the products and the technologies that we're using. I think we're getting there. I think it's just taking a lot of time, even to the fact that one representative, McHenry from North Carolina, has actually proposed this sandbox environment that is a path to a federal charter framework that will allow non-bank, fintech type companies to get licenses for lots of things, everything from lending to alternative currencies to payment processing. So I think that there's a lot of momentum, and I think it's moving in a positive direction.
Mm-hmm.